Welcome friends. So in this session we are going to look at ABM paper 1, and in paper 1 you have module C related to credit management, and under that this topic of companies, types of companies. So we will have a detailed look on this topic. Before we start our session, again let's see what are the kind of questions asked from this topic. According to definition of small company, what is maximum permissible annual turnover? So annual turnover of small company. Then key difference between liability of partners in partnership firm versus LLP. Okay. Then from a banking perspective, why is a registered partnership firm preferred over unregistered one? Which of the following criteria combination is correct for a private company? So these are the kind of questions expected from this topic. This is regarding classification of companies, what is their paid up capital turnover, then if it's a partnership, what are the terms and conditions you should look at, the deeds of partnership, whether the company should be registered or unregistered, number of members in a company, the number of directors. So I think you have got an idea what sort of preparation we need to have from this topic. So let's start with the first topic. So company is anything, it is defined under Companies Act. A company is incorporated under Companies Act 2013, and it is a legal person. Just like an individual, it is like a legal person with perpetual entity distinct from members. So the members of the company may come and go, they may die, whatever may happen to the members, but this is a perpetual entity. It will live beyond all its members, and it is a just like a separate individual only and separate legal person. Okay, so there are two basic criteria for distinguishing between companies, that is private and public. Private is owned by maximum of 200 members, and minimum there should be 2 directors, and the shares in private company cannot be transferred to general public. And under private company we have a special type called one person company. And public company, there should be minimum 7 members, maximum there is no limit. It is, you know that all such companies have this name public limited attached to it. So it is traded on the stock market, the shares are traded on the stock market. So there can be any number of shareholders in the company, but minimum there should be 3 directors, and shares are freely transferable. So this is the basic difference. Now in India, company categorized as follows in 3 ways. They are limited either by shares. So the liability of a company is limited to unpaid share amount. Then limited by guarantee, members guarantee to pay a fixed amount. If a company fails or goes bankrupt, members will guarantee to pay the fixed amount. Then unlimited is where the members of the company have unlimited liability for company debts. There is no fixed amount. Whatever is the debt to be recovered, that will be recovered from the members. So these are 3 criteria. Now we move on to next topic, small company. Small company is the one which has a paid up capital of 4 crore. Maximum paid up capital of 4 crore. Earlier it was 50 lakh, then revised. And it should not have turnover more than 40 crore. So this is the maximum limit fixed. And these companies have lighter compliance, fewer board meeting requirements. Cash flow statement need not be prepared, lesser penalties. Okay, so there are some exceptions which cannot be small companies. Public companies cannot be small companies. Holding subsidiary companies cannot fall under this category. Section 8 companies, we will learn later what are they, but they also cannot be formed under small company definition. And companies which are under special acts, separate act created in the parliament for them, such companies cannot also be small companies. And section 8 companies are non-profit companies basically. Their purpose is promotion of commerce, art, science, sports, education, social welfare, environment, etc. Environmental protection, etc. Financial rule is that their profits should be applied in promoting the objectives they have stated. They cannot return the profits to the members of the company, cannot pay dividends, but it has to be returned to the purpose for which the company was created. So it has to be registered under Central Government's Ministry of Corporate Affairs. Then there are some other types. First is statutory companies. Statutory companies are formed by legislation in the parliament under special acts. For example, SBI, State Bank of India Act, RBI Act, LIC. These are companies formed by passing laws in the parliament. So through special acts, so they are known as statutory companies. Always statutory companies will be governed by their own particular acts. So the whatever conditions and definitions are mentioned in that particular act, that only will apply to these companies. And if there is like Companies Act and then there are special acts, the special act will get preference for these type of companies. Then government companies are one where paid up capital is held by central or state government, and if it is more than 51% or more owned by government, then it will be a government company. In holding and subsidiary companies, holding company has more than 50% capital of another company. Subsidiary company is a company controlled by holding company. So holding company will be the bigger company, and under that there will be a subsidiary. Then associate companies and joint ventures. Associate companies have significant influence, but not like subsidiary where 51% or more than 50% is there. Associate company will have only 20% share capital held by the larger company. Okay. Joint venture is where parties have joint control and rights to net assets. Special purpose vehicle is always created for specific projects. So if there is a big idea, new project to be implemented, for example, a new IT park is to be created, then SPVs are formed to isolate the risk associated with that particular project. Then LLPs, they are body corporate and legal entities separate from partners. So there should be minimum 2 persons for forming an LLP, and the liability of these members will be limited to their agreed contribution except for fraud cases. If it is determined that there is a fraud, then their liabilities become unlimited. Okay. HUF cannot be designated partner of LLP, so that it is not a body corporate. So HUF cannot be part of LLP. The two members, one cannot be HUF. LLP key features that it has legal capacity, can sue and be sued. Partner can cease with 30 days written notice. Partners can leave, and it is internal structure based on partnership agreement. It is more flexible than normal partnership firms. Sole proprietary unit, this is wholly owned by individuals. No legal distinction between owner and business. There is unlimited liability. So whatever is the business, that is the person is same as business. Okay, so whatever business liability is there, that will be the person's or owner's liability. Unlimited liability, no separation like a company. So there will be absence of proper accounts, and personal finances and business finances will be mixed. We cannot really distinguish. There is always a riskier chance. The loans are riskier when you are dealing with proprietary units. Okay, partnership formed between competent persons to share business profits. They are separate legal existence from individual partners, but liability is unlimited liability. Okay, there may be two separate partners, but their liability is unlimited. It is not limited to the amount they contribute. Agreement, there is a partnership deed which will be an agreement stating terms and conditions and rights and duties of partners. As bankers, you always verify which partner has the right to borrow. So what are the shares of profit between partners? What is the contribution of capital among partners? So all these things we can verify in partnership deed. Then partnership deed always reveals details and purpose of the company, duration and bank operations, who can do, is there any restriction on the borrowing limit. And banks always prefer to deal with registered partnerships, because unregistered partnership firms cannot sue debtors for dues recovery. So some company has suppose debtors who have not paid for their products, so now they cannot take action against such debtors because their company themselves are not registered. So that company's ability to realize its money, realize its revenues, will be under question if their debtors don't pay, because they themselves are unregistered, and therefore bank also doesn't prefer to have dealings with such unregistered partnership firms. So here is a quick revision. Private company will have limited liability, minimum one member for one person company, otherwise minimum two members, maximum 200 members. Public limited company, minimum 7 members, then there will be free transfer of shares. LLP should be minimum 2 members, limited liability. Then partnership has unlimited liability, minimum 2 members, and sole proprietorship, unlimited liability. Now let's quickly go back to the questions we discussed. According to the definition of a small company, what is the maximum permissible annual turnover? So the answer is 40 crore is the annual turnover. Key difference between liability of partnership firm and limited liability. Both have partnership firms have unlimited liability, LLP have limited liability. Correct. Liability is both is limited. False. LLP partners have unlimited liability. False. Partners in both have unlimited. So A is the right answer. Banking perspective, why registered partnership firms are preferred? Unregistered have unlimited liability for partners. Registered firms have a separate legal existence. Unregistered firms are not required to have a partnership date. This is the answer. Unregistered firms cannot sue debtors for dues recovery. We discussed just now.